All right, well, welcome everybody to my presentation. It has to do with the complete change in the investment landscape based on the arrival of inflation, the long overdue point where the dreaded monster rears its ugly head. And this is going to completely change the dynamics that have existed for investors over the last decade. Pretty much everything that worked while the Fed was inflating this bubble is not going to work as the air comes out of it. And the air is going to come out of it, despite whatever efforts the Fed may pursue to prevent that. I think they've already pricked this bubble, and there's really no way to prevent it from deflating. So first of all, to discuss the topic of inflation, the first part of the stagflation equation, clearly we have a huge inflation problem, and we've had this inflation problem for over a decade. It's just that it hasn't manifested itself in a way that was problematic to the Fed or to investors, because the inflation was resulting in asset prices going up rather than consumer prices. I mean, consumer prices went up, but not by an amount that caused an alarm, especially since the government was able to disguise the true degree to which prices were rising with the CPI, which doesn't really do a good job, I think, by design, of accurately reflecting what's happening in prices. It substantially understates the degree to which prices are going up. And so given the ability of the government to pretend that we had inflation below 2%, that gave the Fed cover to continue to create more inflation under the guise of quantitative easing and stimulus and 0% interest rates. But that money flowed primarily into financial assets, but it also fueled a record increase in U.S. trade deficits. In fact, this morning, we got news that the December trade deficit was a new record, $101 billion. That is the first month where we've had a trade deficit in excess of $100 billion. This is merchandise trade, goods. And for the entire year, our trade deficit in goods eclipsed $1 trillion. That is an unheard of deficit. Never before has anything that bad been achieved, by any nation. And so part of that actually kept a lid on inflation, even though the way the government measures inflation, we had a 7% increase in consumer prices. Imagine how much more consumer prices would have gone up had $1 trillion worth of stuff not been dumped into our market by our trading partners. And how did we pay for all this stuff? We didn't. We printed money, and we exchanged the money we printed for the goods that that the rest of the world produced. And Americans didn't even earn a lot of the money that they spent. It was just handed to them by the government in the form of stimulus checks or other bailout money. And where did that come from? Well, it came from the Fed's printing press. We did the worst possible combination of monetary and fiscal policy in 2000, when we first entered, the pandemic, March of 2000, because as the economy was shutting down due to COVID and due to government restrictions as a result of COVID, instead of doing the right thing and contracting money supply along with the economy, so demand would go down with supply, the government and the Fed conspired for the worst combination of monetary and fiscal policy probably in the history of the United States. As millions of Americans were leaving work, the government mailed everybody checks to replace their paychecks. But the key is when you're earning a paycheck, you're being productive. You're helping to produce goods and services, and then you're rewarded with pay, and now you can consume some of the goods and services that you help produce. But when you're not working, you need to consume less. But the government didn't want that, because that would have meant a more severe recession. So the government sent everybody money to buy goods and services that they weren't producing. And the fact that we have big shortages should not have been a surprise. I mean, it's an obvious consequence of a failure to produce. You don't have stuff and you get a shortage. But we had all this extra demand thanks to the government and the Federal Reserve. And we haven't even really begun to feel all the consequences of that inflation. I think the inflation that we've experienced in 2021, a lot of that was largely the delayed consequence of the inflation that was produced prior to 2020. I don't even think we've caught up to that inflation yet, which is one of the reasons that we're going much higher. You know, not only wasn't inflation transitory, but it's going to be far higher than it was during that supposed transitory period. And of course, I was one of the few people, in fact, at the Money Show in earlier presentations, when the Federal Reserve was claiming that the inflation we were experiencing would be transitory. At the time, I said the Fed was lying about that. I said that inflation was as transitory as the subprime market was contained. That's exactly the lie that the Fed told us in 2007 when the mortgage market blew up, the subprime market. The Fed told us not to worry, that there wasn't going to be a problem, that the damage was contained to this small segment of the mortgage market. It wouldn't affect the overall housing market. It wouldn't affect the economy. And of course, we ended up with the 2008 financial crisis. I think in many respects, people at the Fed might not have even believed those lies, but they told them anyway because they wanted to placate the markets. They didn't want the markets to be afraid of what was going to happen. And I think that was pretty much what they were doing again this time. They didn't want to level with the markets and deliver the bad news about how bad inflation was going to be. So they just pretended it was transitory. Now, maybe they also hope that the problem will go away. In fact, they're still hoping it's going to go away, because if you look at what Powell is talking about doing in order to fight this inflation that it now admits wasn't transitory, is too little too late. What is the Fed proposing? Well, in March, they may raise interest rates from 0, where they remain, to 0.25%. And then maybe by the end of this year, they will have raised interest rates up to 1% at the end of this year. And then maybe at the end of next year, they will raise interest rates to 2%. Now, how are you going to do something about an inflation problem by throwing gasoline on it? Because a 1% interest rate, even if we get there at the end of the year, is still a stimulative rate of interest. In fact, 1% is the rate that Alan Greenspan slashed interest rates to in 2002 when he wanted to stimulate the economy following the September 11th attacks and the collapse of the NASDAQ bubble. That was considered a very stimulative monetary policy. Yet somehow now it's an aggressive tightening that's going to take care of the worst inflation in 40 years. And the reality is, it's not the worst inflation in 40 years. It's the worst inflation ever. Because 40 years ago, when we were measuring inflation, we were using a very different CPI than the one we're using now. So you can't really compare the CPI today to the CPI 40 years ago when they're completely different. So if you measured what happened to prices last year with what happened 40 years ago using the same CPI that was being used then, in 2021, we had an increase in consumer prices of about 15%. And that would make it higher than any year of the 1970s. In fact, it would be higher than 1980, which until last year was the high watermark for the CPI at 13.5%. But how did we put out the inflation fire in 1980? Well, Paul Volcker brought interest rates all the way up to 20%, so that we had a real rate of interest of 6.5%, and we created a powerful incentive to hold on to US dollars and to save money, because we offered savers a very high real yield on their savings. And of course, Treasury bond yields also soared. I think the yields on 30-year bonds got up to something like 14%. And so we were offering a positive yield. Well, even if the Fed follows through with their commitment to raise rates to 1% by the end of the year, inflation, even if you believe the government's numbers, which I don't, at 7%, 1% is still a negative 6% interest rate. You are not going to encourage savings with negative 6%. You're not going to discourage debt. You're not going to do anything to change the dynamic. You're not going to get out in front of the inflation curve. You're going to fall further and further behind if you continue to stimulate with cheap money. Now, yes, it's not as cheap as it was if the Fed allows rates to rise to 1%. But if inflation continues to accelerate, which it likely will, real interest rates will actually be falling, even as the Fed is slightly raising nominal interest rates. So they're actually pursuing a more stimulative policy while pretending to tighten. And of course, the Fed continues to print money. It continues to monetize government debt. Not only have they not stopped the presses, they're still cranking them up. They continue to buy U.S. government bonds and mortgage-backed securities. Now, the Fed is saying that they're going to wind that down, but they haven't actually done it yet. So they're continuing to make this inflation problem worse. But here is the bigger problem. The only way the Fed was able to justify these artificially low interest rates and quantitative easing was under the pretense that an absence of inflation gave them the leeway to do that. In fact, they actually had the gall to claim that inflation was too low when it was below 2%, even though had they measured it honestly, it would have been above 2%. But using the rigged data that they had, they were able to point to an inflation rate of 1.5, 1.6, and claim that that wasn't enough, that we needed 2%, that their mandate was 2% CPI, which of course it's not. Their mandate is price stability. So stable prices are prices that are flat. They don't go up. If their mandate was 2% increasing prices every year, then their mandate wouldn't be price stability. It would be prices going up by 2% a year. But they kind of redefined their mandate to a rising cost of living. And then they claimed that the cost of living wasn't rising fast enough. And therefore, they were going to pursue this easy money policy in order to deliver a more substantial annual increase in the cost of living. Now, apart from the pure nonsense of that argument, because too little inflation was not a problem. In fact, any inflation is a problem, and the more you have, the bigger the problem. But now that inflation is triple or more, 2%, there is no way the Fed can justify maintaining the artificially low interest rates, because even if they raise interest rates to 1 or 2%, they're still artificially low. And there's no justification for that if you're going to claim it's because inflation was too low. Now, inflation being too low was never the real reason. That was just the excuse that the Fed gave. The only reason that the Fed kept rates so low was because we had such a gigantic debt bubble that those low interest rates were the only thing keeping us afloat. If interest rates were allowed to normalize, we would have a far worse financial crisis than 2008. We would have all the big banks that we bailed out failing. We'd have a crash in the stock market. We have a crash in the real estate market. And not only would the private sector have difficulty servicing its debts if the Fed were to allow interest rates to go to a natural level, but the United States government would also be in the same predicament, maybe even in a worse predicament. The U.S. government would be forced to default on its national debt. We've got a $3 trillion national debt right now, and it's financed at 1%. And it's not financed at 1% with 30-year government bonds. It's financed with 90-day T-bills. The government has to constantly roll over this low-yielding debt in order to keep the financing at 1%. Well, 1% of 30 trillion is 300 billion. Well, what if interest rates went up to 10%, which is half of what they got to in 1980 under Paul Volcker? 10% of 30 trillion is 3 trillion. There's no way the government can come up with an extra $3 trillion each and every year to service the national debt. So the only way to keep the government in the position where it can pretend it's solvent is to keep interest rates artificially low. But the Fed couldn't tell the markets the truth about why it was keeping interest rates low. So it came up with a lie about inflation being too low. Well, what's the new lie going to be? Because now inflation is too high. In fact, inflation is now the #1 problem on the public's mind. The public is dealing with sticker shock every time they go to the supermarket, the gas station, and that's only going to get worse. And this is the worst possible problem for the Fed, because there is no way to actually fight inflation without creating a massive financial crisis and putting the US government into insolvency. In fact, Powell himself admitted that we are on a fiscally unsustainable path, but he says that we can handle the debts because interest rates are low. All right, well, what happens if interest rates aren't low? We can't handle the debt. And the same thing for the Fed. The Fed would be bankrupt if interest rates went up based on its $8 trillion balance sheet, which is loaded up with longer-term U.S. government bonds that would crash in value were interest rates to rise. So the Fed itself would be insolvent. So the reality is the Fed is caught between a rock and a hard place. There is no way out. There's only a bad choice and a worse choice. The bad choice is to fight inflation, let interest rates go up, and let everything collapse. The worst choice would be to continue to create inflation to avoid that and postpone the consequences of hyperinflation. But unfortunately, that's likely the choice that they're going to make. And so what do investors need to do based on this new reality? Because even though the Fed is still going to be providing cheap money, it's not going to be cheap enough to sustain the bubble. The air is already coming out of the bubble merely based on the fact that the Fed is talking about tiny rate hikes in the future has already collapsed a lot of the bubble stocks. A lot of these stocks are down 50% or more, and they're going to continue to fall. In the meantime, look around the world as the NASDAQ, as I'm speaking, I think the NASDAQ's down about 14%. I think it's rallying this morning, so maybe 13% this year. S&P was off about 9%. Foreign markets are up, especially if you look at the value stocks. We're seeing huge rallies in dividend-paying stocks in Europe and Asia, stocks that have been left for dead for years, stocks that were used as a source of funds. People are now piling into those stocks as they liquidate these overpriced assets, because you can't go to cash right now. In an inflationary environment like the one we're in now, if you want to get out of overpriced US stocks, companies that don't earn money, that trade on a dream, that have high PEs or no E's at all, and they just trade on hope and prayer, as people are selling these stocks because the momentum is no longer there, they can't go to cash because inflation is going to destroy the value of their cash. They can't go to bonds because they have the same inflation problem with bonds, only worse, because they can't get their cash until the bonds mature, and they could take a huge loss on the bonds if they want to sell prior to maturity, as ultimately long-term interest rates go up. So where do you go when you get out of overpriced US stocks? Well, you got to go into underpriced foreign stocks, which basically allows you to accomplish two things. You get out of US stocks and you get into better valued companies that actually make money right now, not potentially in the future, but that make money right now, making things, selling things, generating earnings, and paying dividends. But you also get out of the US dollar, because the dollar is going to collapse when people understand that the Fed has no ability to control inflation, and inflation is going to continue to erode away the value of the dollar. What we've had recently is high inflation numbers have actually caused people to buy the dollar because they expect the Fed to successfully fight off that inflation with high interest rates. And it's the anticipation of those higher real interest rates that have been supporting the dollar. Well, when currency traders realize that even if the Fed raise rates, they won't do it enough to stop inflation, and that real rates are going to be falling even as nominal rates are rising, then the dollar is going to fall through the floor. And we're going to have the worst of both worlds, inflation and recession. The economy is already contracting. If you look at the data that we got, or close to contracting, if you look at the data we got at the end of last year and the economic data that we've got this year, you can see a sharp deceleration as the air is coming out of the bubble. But what's really going to cause this recession is inflation, because inflation is going to drive the cost of living up so high that Americans are going to be spending a very high percentage of their disposable income on the basic necessities: food, energy, rent, insurance, healthcare. They're not going to have money left over for discretionary spending. And that means the people who earn a living in the part of the economy that benefits from that discretionary spending, they're going to be unemployed. And in fact, there's going to be a lot of people who are going to be joining the ranks of the unemployed who over the last year or two didn't work because they made a lot of money in meme stocks or cryptocurrencies. And as their paper fortunes blow up, a lot of these millennials are going to realize that they actually have to get a job, that they can't live off of their trading prowess. They're not the geniuses that they thought they were. They're going to be looking for jobs. And in fact, a lot of retirees who thought they would never work again, they're going to be back in the workforce because inflation is going to decimate the value of their portfolios. At least workers, you can get a wage that will increase. It probably won't increase as much as prices, so you're still going to fall behind. Your real wages are going to go down even if you get a nominal raise. But if you are retired and you're living on a fixed income, that fixed income is going to be obliterated by inflation. And now what are you going to do? You no longer have the ability to put food on the table or pay the electric bill based on your retirement income. You've got to go back into the workforce. And until you find a job, well, you're unemployed. And so I think unemployment's going to spike up. We're going into a recession, and there's nothing the government could do about it. There's nothing the Federal Reserve could do about it, because what they normally do to stimulate a recession is they create more inflation. They print more money. Well, how can they do that if you're already having an inflation problem simultaneously to your recession? How can you try to cure the recession by making inflation worse? And if the reason for the recession is inflation, and you deliberately make inflation worse to try to stimulate the economy, you're actually going to sedate the economy. You're going to make the recession that you're trying to cure even worse with your monetary cure that doesn't work. So we're really at the end of the rope for the Fed. I mean, they've been kicking the can down the road for over a decade. They've been papering over every recession, every stock market decline by creating inflation and hiding behind the guise of the fact that, hey, inflation is under 2%, so we could do all this. And they kept saying all the time, if inflation ever gets above 2%, well, we've got the tools, we'll do something about it. And I was saying the whole time, they don't really have the tools. Maybe they have them, but they'll never use them because they would completely obliterate the bubble economy that they've spent all of these years inflating. So it was all a bluff. It was all bark and no bite when it came to inflation fighting. In fact, the Fed was trying to carry a big stick, or the Fed was pretending it had a big stick by talking tough, knowing that it had no stick at all, because it is impossible when you have an economy that is so levered up, and the only way to cure inflation is to force a deleveraging, is to raise interest rates and shrink the money supply. Given how much debt we already have, it's impossible. And the reason the economy is so loaded up with debt is because of the monetary policies pursued by the Fed. So the crisis that we're going to have, just like the financial crisis of 2008, was completely manufactured by the Federal Reserve. It was bad monetary policy that inflated this bubble, and it's bad monetary policy as it deflates that's going to make the situation much, much worse. But for investors, the path is clear. You got to get out of U.S. stocks and out of U.S. bonds in particular. You got to get out of the dollar, and you need to be in inflation hedge investments. One obviously being gold and silver. Gold prices, as I'm speaking, are around $1,850 an ounce. We're still below the highs from last year, which were about $2,100. Gold has been consolidating one of the reasons that gold hasn't gone up is because everybody has expected the Fed to successfully fight off inflation with a tighter monetary policy. Again, monetary policy will be less loose, but that's not enough to win a battle with inflation. It may be enough to prick the bubble in tech stocks, but it's not going to derail this inflation juggernaut. And when people realize that, they are going to be piling into gold and silver. Prices are going to go up dramatically. I think we're going to have another leg similar to the leg we had from 2001 to 2011, where gold was up about 5x. It could easily happen again. And that means the money that's going to be made in the mining sector is going to be even bigger. That's where your speculative funds should be invested. Forget about tech stocks. They're old news. They worked in the past. They're not going to work in the future. What's going to work is what worked in the 1970s, the last time we had stagflation. Of course, this time it's going to be far worse. The inflation is going to be much worse. The economy is going to be much weaker. And unfortunately, we won't be able to put a stop to it like we did in 1980 because we have no ability to raise interest rates because the country is completely insolvent, which was not the case in 1980 when we were still a wealthy creditor nation. We still had trade surpluses. We had relatively small debt relative to GDP, the mirror image of America today. So we're not going to have a positive ending like the one we had with Volcker and Reagan. We're going to have something completely different and catastrophic. And so it's even more important that you stagflation proof your portfolio because it might end up being an inflationary depression, not just a recession, but a depression. And the inflation could end up being hyperinflation. And so you also want to get into foreign equities. I think that should be the bulk of a portfolio, good dividend paying foreign equities. A portfolio like that in early 1970, if you divested of the US stock market and you got into German stocks, you got into Japanese stocks, you did great during the 1970s as people who stayed wedded to the US stock market got killed, and they got killed even more if they stayed in the US bond market. So you need to follow that blueprint. I mean, most investors today weren't even investing back then. They have no idea how to do anything differently from what they've been doing. And I think most investors have no idea what's already happening. They haven't even looked beneath the surface of what's happening during this market meltdown to realize the huge rotation that is taking place, that there are stocks that are making 52-week highs in sectors that no one has been buying in years because everybody wanted momentum. Well, now the momentum is down and it's a race to get out. But a lot of people won't even realize what's happened. They've been conditioned to buy the dip, and it doesn't matter to them if the market goes down. They're confident it's going to go up, whether you're talking about, overpriced tech stocks or cryptocurrencies. Everybody thinks that every sell-off is going to be followed by a move up to new highs. And so they're complacent, they're not worried, and they're going to get obliterated. But what the smart investor has to do is recognize that the day of reckoning is here. A lot of people, don't understand that because they had no idea that there was a problem to reckon with. Just like so many people were surprised by the financial crisis of 2008. I wasn't surprised. I had been expecting it for years. It finally happened. This next crisis is going to be much worse. Again, the same people that were blindsided by the financial crisis of 2008 have no idea that this even larger crisis is around the corner. I do. I've been expecting it for years. The one thing that surprises me is not that we're here, but that it's taken us so long to get here. And the bigger problem is because we succeeded in kicking the can down the road for so long, all of the problems that are going to create this crisis are now much bigger. And therefore, the ensuing crisis is going to be far worse than what we would have experienced had we experienced it sooner, which means the stakes for investors are that much higher. So I would invite everybody who is listening to this talk, who is at this Money Show, to contact my office, talk to my representatives at Euro Pacific Capital, Euro Pacific Asset Management, and let us help you build the type of portfolio that you need to survive and thrive through these uncharted waters and an investment landscape that almost no American has experienced and no American is prepared for. Thanks, everybody.